All right, so today is Monday, February 5th. This is the 2 p.m. section. This class is being recorded for YouTube. So as we get started today, attendance sheet. This is today's attendance sheet. Please make sure you fill this out before you leave today. Sign your name. You can start it on this side of the room and pass it around. So in just a few minutes, we're going to finish up some stuff on lecture note 1. But before we do, I want to talk about the EIC homework 2 and also your Bloomberg Trading Challenge. So if I go to TMSG, and we look at this section, which is 301, here is where we are today, ranked on portfolio value. So the good news, 1, 2, 3, 4, 5, 6, all 6 teams have started trading, which is great. I don't count, I just did my sample trade last week when I bought Lilly. But basically, this is the ranking as of today. By Wednesday, end of day, you need to be below 300,000 in cash. So these teams still have some buying to do because this would still be disqualification. 300,000, 823 is still 824 above where you need to be. But you have between now and Wednesday to make the extra trades. But this is how you're going to be ranked. You're going to be ranked on portfolio value from highest to lowest. And we can see that all 6 teams, even though you haven't fully traded yet, are in making money. They're all positive returns so far. Questions? Yes, nobody bought Meta before they did their earnings release and skyrocketed 20% on Friday. We missed that trade. Oh, you did? Congratulations. So, but anyways, questions about the trading challenge? Okay, so the other really good news is for your Bloomberg certification, which is due end of day Friday, Bloomberg Market Concepts. Somebody in the 11 a.m. section mentioned that sometime in the last week, Bloomberg added a 5th module as required for certification. They put a blue badge next to the Terminal Basics module. And they've done that in the last week. And I didn't notice it, but one of the students in the 11 a.m. section did. And they said, wouldn't it be great if that was part of the certification for this class? And I agreed with them. And I said, that's a great idea. So your certification is now 5 modules, no longer 4 modules, because we're keeping up with Bloomberg, and you have to do the certification, which includes the Bloomberg Terminal Basics module. So if you've already submitted your screenshot, you can do a second screenshot. But you got to get that module with 70% done by Friday as well. I'll make an announcement later today, because I thought what would be good for one student would be good for the other 181 students registered for the class. Yes?
So if we've already done it, just do the terminal.
Just do the terminal, do the screenshot of the terminal. Yes. Question? So any questions? I thought everybody would appreciate the news because it just gives you more to get certified on. Keeping up with the real certifications. All right. So let's talk about homework 2, which was your EIC on Lockheed Martin. Okay. So the first thing you would have done is you need some screenshots to do the E section. So you would have gone to LMT, US Equity. You'd have gone to RV. And then you would have gone here to Markets Beta. And with the best fit algo, country of domicile, or US basically, you should have come up with a list that looks something like this for your screenshot. And again, export, screenshot, save. Okay. Now, I mentioned in previous classes, your data might look slightly different than this because this is real time. Okay. So for example, if you did it on Wednesday or Thursday last week, you might have slightly different data than doing it Monday today. It's one of the reasons why I ask you to turn in screenshots. So you turn in screenshots so you can show you did the work and you can refer to data, but you also do screenshots throughout the semester because when the TAs are grading this, your data might be slightly different. I mentioned Meta and the share price skyrocketing 20% on Friday. So if somebody did a valuation of Facebook on Thursday and a Facebook on Friday, you get 2 different valuations. And so that's the point. Like the screenshots are points in time at which your data is based upon. Okay, so again, if your data looks slightly different than this, it should be dramatically different. This is the data through this morning. All right. So Lockheed Martin and the market cap weighted average raw beta for the industry 0.61. Okay, so what you should have said as part of your E is that the defense and aerospace industry is about 61%. As cyclical as the average S&P stock, which makes them a little bit less economically sensitive. Lockheed Martin with a beta of 0.48 is even less economically sensitive than their industry with a beta of 0.61. Okay, so that's the data that you needed to take the screenshot of and reference. Any questions about that? All right, then the next question is why? What makes this industry less economically sensitive? What kind of drives their lower beta? Why are they a little bit more immune to changes in the economy? Yeah.
Inelastic demand.
So say more about the inelastic demand.
They are providing technologies for oftentimes the U.S. federal government, and so U.S. federal government is never not buying new technologies.
Yeah. So since most of their sales for the industry are going to the U.S. government in this case, because they're U.S. firms, that as a result, that takes the supply and demand changes you see for a commercial company kind of off the table. You don't see the big swings, right? And so that has tended to lower the betas of these companies, right? So really good insight. What else helps with the lower beta? Yeah.
Is longer term contracts, shorter term, like this term?
Yeah, so they're signing very long-term contracts. You know, you work at Cisco, you're trying to figure out where you're going to get routers sold in April, right? These companies have sales locked up for over 2 years. Matter of fact, I don't know if anybody paid attention to what's called backlog. Backlog is a big deal in this industry. There's another part of Bloomberg called FA, which is historical data, financial analysis. And this is where they're pulling data from like the SEC website, 10Ks, 10Qs, 8Ks, etc. So under segments, segment data from the 10Ks, scroll down here, and this is what they report in what's called order backlog. As of December 31st, they just reported their earnings, Lockheed Martin had $160 billion of order backlog. That means they've already sold $160 billion of stuff under contract, right? Last year, I think they had like $67 billion of total sales. They got over 2 years of sales already sold, right? So again, that tends to make this industry a lot less cyclical because they have these very long-term contracts. And Lockheed Martin is just a proxy for this, but the whole industry benefits by the nature of backlog, right? What else tends to make the industry beta a little bit lower? So we got backlog, we got the long-term contracts, we got the nature of the government. They're contracting with the government, who's a little bit more predictable in their spending, usually plus or minus 1 or 2%. Anything else you guys want to talk about? Or what about Lockheed Martin? Why is Lockheed Martin more predictable than the average company? Why is their beta lower? Yeah.
Well, I'd rather they have like an insanely long background in the industry.
Well, that's the 160 billion. Yeah, so that helps them. But there's another part of Lockheed Martin which helps them more. Yeah. Look like you want to say something?
Was it like their product line, how they have like they offer revenue by it was like 3 of the services compared to like 2 for the average.
So they're a little bit more diversified. But, and you can see this here off their 10K, like their biggest contract, they're called programs, by the way, not projects, because they're so big. Their biggest program is the F-35, which is a big chunk of their revenue. It's the biggest aerospace contract in history. And so they're basically in production mode for these F-35s. They also make the C-130 cargo plane. They make F-16s. Matter of fact, when NATO allowed Sweden to join, Turkey was the holdout. And this quid pro quo here, they didn't really directly say this, but basically Turkey's wanted F-16s for a while. The U.S. has blocked their sales. Lockheed Martin couldn't sell it to Turkey. And so when Sweden was allowed to join NATO and Turkey finally approved it, basically the next day they announced that Turkey was buying a bunch of F-16s. So that tends to help them because they're selling these really big programs. They're the only game in town for certain of the fighter jets. And these contracts are very long-term stable. Okay, so they just have a very predictable business, right, at Lockheed Martin, which also bleeds over to the I part of this. which is because they're big, they're also big in areas that are very important to the government. So the government's not going to cut spending in certain of the areas that Lockheed Martin or many of these defense contractors are in, but that's heavily benefited Lockheed Martin over time. Okay, but that's something along those lines. What you should be saying, you should be talking about why is the industry less cyclical, why is it not as tied to the economy, why is Lockheed Martin tied even less? You have some idea about that. Make sense? All right, then you would have moved on to the I, and in the I, you'd have done the second screenshot, which is your spread screenshot. So you'd have gone to RV custom. And your spread template based on latest year. And again, referencing the top row for market cap weighted average, loads, we would notice that the industry has an ROIC latest year in this data, 9.93%, cost of capital 7.29 today. So that's a positive spread of about 270 basis points. And so this is an attractive industry. So the whole point of the first part of the I and the five forces, using the five forces, why? Explain the positive spread that we're observing. Is it because the buyer power, the supplier power, barriers to entry and exit, rivalry, substitutes, using those five forces, what's favorable? So which of those forces are helping this industry have a slightly positive spread? Yep.
Barriers to entry.
Barriers to entry being?
Like it requires very high levels of capital to set up manufacturing.
Okay, so the barriers are high levels of capital. That's one thing. You're probably not going to graduate as a senior and then start a defense and aerospace company, all right? But what else? What else is about a barrier to entry? They actually do have very high barriers to entry. Yeah.
Because of all the regulation the government tends to trust, like established.
There's regulation, especially when you get to the military stuff. But there's something even more simple about the military stuff that makes it harder for anybody to just go do. Yeah.
It also takes enormous amounts of capital to do these R&D like research.
The capital's important, but there's actually something even more stringent. Yeah.
Is it just the already existing contracts with the government that these companies have?
It's not the existing contracts, which they have locked in. It's the,
The technology itself.
not just the technology,
Security clearance?
it's the security clearances. You have to work on classified programs, which they do a lot of, you have to have a security clearance. And I don't know if anybody's applied for a security clearance before, but right now it's going to take 12 to 18 months. Okay? It's a very long process to get security cleared. Matter of fact, if you work at Lockheed Martin, they joke, they call you the tank. You're going to be in the tank for a year. Basically twiddling your thumbs, not doing anything. They got busy work for you to do because you can't do your real work till you get your clearance. And so having security cleared engineers is actually a very big barrier to entry into this marketplace. Right? So it's not easy to just go get me 2,000 security cleared engineers. And so as a matter of fact, a lot of historical M&A in the industry has been buying other companies, not for their products, but for their secured engineers. And so Lockheed Martin actually has the highest collection of secured engineers of any commercial company. All right, and that gives them, they win a big contract, they actually have people that can go do it. Another company has a big contract, they gotta go wait a year to start because they don't have the engineers that are cleared to go work on this. So that's actually given them, we get the competitive advantage, some of their competitive advantage over time, okay? But they're still, the whole industry is looking for engineers, all right? So nonetheless, security clearances, high capital costs, these long-term contracts, all those pose pretty big barriers to entry. What else is favorable in the five forces? What other forces? Yep.
Rivalry or concentration.
Is there a lot of rivalry in the industry?
There's a very low level of rivalry in the industry. There
Bec-
are very few companies that are the size of Lockheed Martin, and as you've already mentioned, equipped to do what they do at that scale.
Exactly. So basically, there's very few companies that kind of are in this industry, and it's hard to get in, and it tends to reduce the rivalry, but there's another reason. They've kind of chopped up the business as an oligopoly. Okay, meaning if you want to get cybersecurity done, and these companies actually do the back-end cybersecurity for the U.S. government. And so the big company is RTX, used to be called Raytheon. They actually do cybersecurity to protect the NSA, the CIA, the Department of Defense. They're the back end, and as contractors. The other company is Lockheed Martin. So there's two companies that are really big in cybersecurity for the U.S. government, but that's it. Because if you win the award, you get the contract, but the nature of awards in the business, if you lose the award, you're out of the game. So you're not going to see 10 companies competing for cyber contracts because 9 of them are going to be out of the game when there's a winner awarded. So they don't tend to go outside their areas too much. So cyber is locked up by 2 companies. Another big area is missiles, hypersonic missiles, right? Which you've seen Russia attacking Ukraine almost on a daily basis with those. And there's a big competition between the US, China, and Russia for the next generation of hypersonics. So happens that Lockheed Martin is one of the companies that makes hypersonic missiles. And there's not that many. They also make, they own Sikorsky helicopters. So you want a helicopter, you're going to mostly Lockheed Martin to get your next Black Hawk, right? There's not many other companies that do helicopters for military. They also control the F-35, the F-16, the C-130. If you want commercial commercial aircraft, you got Boeing and Airbus. You want a fighter aircraft, you got Lockheed Martin, and that's it. So these companies have kind of locked up certain areas of the defense market and reduced competition amongst themselves in those industries. And that has reduced the rivalry and to some degree diluted the buyer power. So even though the customer, you think, oh, they're the US government, they can dictate terms, well, who are you going to dictate to? Because you're negotiating with one supplier. All right, so you don't go with them. It's not like you can go find another supplier quickly to replace them. So on the one hand, yeah, the buyers have power. On the other hand, because there's not too many choices for certain things they do, it's kind of reduced the government's power. All right, and that has benefited this industry over time. Okay, yes.
Is it true that the companies within this defense industry what allows them to also allows, the lower power buyers that kind of each company is sort of specialized in has a specific need?
That's what I'm saying, exactly. They've all kind of specialized. Same thing, you want a destroyer, you want a ship, naval ship, Lockheed Martin doesn't make them. You're going to Northrop Grumman. And so basically Northrop Grumman is going to win the next ship contract. All right, you want a fighter bomber. All right, you're going to Northrop Grumman. All right, they make the fighter bombers. Lockheed makes the fighter planes, but they don't really overlap between the two. So you're right, they've kind of chopped up this industry, which has reduced the rivalry. Another thing that's kind of interesting is if you go to SPLC at Lockheed, and this is just a proxy, remember we're still talking about the industry, but that's supply chain. Very powerful screen in Bloomberg. On the right are a company's biggest customers. On the left are a company's biggest suppliers. Suppliers based on cost of goods sold, percentage of that, revenue based on revenue. You can see for Lockheed Martin, US government, 73% of their revenue. Okay, so almost 3/4 of their business is going to the US government. Right? You look over the suppliers though, their 4th biggest supplier is RTX, which is also a competitor. BAE, competitor supplier. Aerojet, competitor supplier. L3 Harris, competitor suppliers. So 4 of their top 7 suppliers are actually their competitors. And that's pretty common in the aerospace industry. It's very incestuous. They compete with each other, and if they lose the bids, they supply to each other. Okay, so it again reduces the competition, increases the barriers to entry, and actually helps the industry be a little bit more profitable. Okay, substitutes. Are substitutes viable, or are you going to add something else?
I was just gonna ask, does the government try to increase competition? Because I read that the Federal Trade Commission tried to block an acquisition by Lockheed Martin.
Well, they're trying to reduce or help the competition because through M&A, there's actually less defense aerospace, which means there's less choice for the government. It's actually not good for the government if you don't have as many suppliers. So that's one of the reasons why they're blocking some of these mergers, because they'd actually like to have a second player. They don't want one company to do it all, if possible. So on the one hand, there's not a lot of competition, but they'd like to see some, but that goes back to substitutes. Like, are there viable substitutes for this industry? Yeah,
Not really.
for the most part.
For the most part, no. Obviously it depends on the equipment or the vehicle or whatever it is that the government's looking for. But if they're specifically looking for planes, like you said, they're not going to find any substitutes outside of Lockheed Martin.
Exactly. Although there has been, on the commercial side, one area that has been more of a substitute is in space. Matter of fact, why? What's the company? Yeah, SpaceX. So another Elon Musk company, SpaceX, has created a commercial, basically rocket launching business. You want to launch a satellite, other things. Government doesn't directly control it, SpaceX does. And the government has actually been using that to help launch satellites and other things into space. And so that's an area where substitutes have actually come in and competed. Matter of fact, part of SpaceX is Starlink, satellite internet. Okay? And I was telling the class, in January, I'm getting old now, I take cruises. So I took a cruise to the Caribbean. We went to Aruba and Curacao. And when we were chugging down there from Fort Lauderdale, it was 85 there while snowing here. Didn't miss any of that. But the important part is I was on my Starlink internet, which Royal Caribbean uses, and I had 30 megabits up and down from my cabin in the middle of the Caribbean, right? That's impressive, just with technology, what it's going to do. But here's what they're doing. Ukraine is at a severe disadvantage to Russia in terms of technology, military, etc. But they've been using the Starlink satellites to basically run their military. Okay? And so it's shown the government that you actually don't have to be a defense contractor. You can actually use some of this commercial stuff to do real world warfighting. And it's changing the game. I mean, there's a lot of stuff we're learning in the world today that is completely changing the game about where some of these substitutes might be viable. That before we want to build it all ourselves, have proprietary technology, we might be able to use commercial off the shelf with encryption and basically be a substitute that's viable. Okay. Saw a hand there for a second. Okay, yes.
Do you think that's realistic?
Ukraine's doing it.
I'm
Now,
saying, like, do you think Lockheed Martin and Northrop Grumman will ever kind of become smaller in the next, I guess, 20 years?
I don't think they're going to become smaller, but I can see them. I mean, Lockheed Martin Space Business is looking exactly at what Musk is doing and saying, can we do something similar? I mean, that's public knowledge about what they're trying to do. Everybody's trying to do stuff to make the government buy stuff more cheaply, as less money is being acquired or trying to there. But at the same time, we'll never go to a commercial company. Any country would. U.S. wouldn't, Russia wouldn't, China wouldn't, to basically bet our entire future on a commercial company when a war breaks out. Okay, and so, but nonetheless, these technologies can be brought in, and it's become a little bit more viable. But it doesn't really change the game in a way it's hurting this industry. Not today. Yes.
There's recently been a lot of moves within the space technology sectors, especially with not only Elon Musk, but last year we had Bezos with Blue Origin and
Yep.
Virgin Orbit. Does that also pose as a risk? Or
Well, again, today probably not, but we're also going to talk about 5 years, and maybe these substitutes for part of the business become more viable over time. Okay, but that's the point. Like the forces, the other one, suppliers. You can see here, suppliers are not really a threat because they're either vertically integrated or they're competitors or they're suppliers, and really it's just, can I get the engineers to do the work, right? And that, you don't have a lot of power over these companies. Now, there is substitutes in the engineers, meaning you could go work for Meta and make a whole lot more money than you would at Lockheed Martin. But at the same time, you don't get the job security, because you can see a bunch of people at Meta just got laid off, and Google's going to lay off 35,000 people. So jobs are not safe in Silicon Valley anymore, even though they're higher paying. Lockheed Martin, they're pretty safe. They don't do major layoffs. They tend to keep you for a long period of time. So that's one of the benefits there, is job security. But you're also not going to make as much money. But again, hasn't seemed to affect them too dramatically. As a matter of fact, as Silicon Valley is cutting back, the defense and aerospace is benefiting, because these people are then going across the street and getting some jobs. But you just got to get security cleared. But long story short, the question then becomes 5 years from now. Is any of this going to change in the next 5 years? All right, you got to make an opinion at that point. All right, you can obviously read what some of the things said, but to be honest with you, my opinion is I don't think the rivalry is going to change that much in 5 years. You're not going to see a bunch of new competitors pop into space. All right, most of these contracts, which are very long term, are kind of locked up already. All right, the industries themselves have the businesses chopped up, so they tend to focus on their areas, and it's hard to get with these big established players into their areas and see new competition emerging anytime soon. Not saying it can't happen, but it's just harder to happen. And so again, the substitutes, though here and there, are not dramatically changing the industry. Barriers to entry are still high. And so again, I would argue you're still going to see probably a pretty good industry in 5 years. Now, you could have a different opinion, but you'd have to explain and talk about your logic and talk to that, or it could get even better. You could argue that. But you had to say something about that, how they'll change in 5 years. Then competitive advantage. Back to the RV spread, does Lockheed Martin have a competitive advantage? So remember, we're carrying their relative spread to other people. And so based on the data today in this screenshot, we are going to see that Lockheed Martin clearly has a competitive advantage, because their ROIC is going to be, wait for the number, 25%-ish against about a 10% WACC, if I remember correctly from the earlier section. 24.5% ROIC against a 7% WACC, so they got about 17.5 points of spread. Industry's only got about 2.7 points of spread because of the 9.93 versus the 7.29. So clearly, they're outperforming the industry, okay? And so again, what makes Lockheed Martin good? Another thing is they've become a platform business, okay? They make the F-16. They made 4,000 F-16s. They're pretty good at making F-16s. The more they sell, the more they make, economy of scale. They make a lot of C-130s. The more they sell, the more they make. So because helicopters, they make the Black Hawk helicopter. The more they sell, the more they make. So one of the things that's benefited them over time is they make some platforms, which they sell a lot to the government, and they're getting economies of scale. And that's actually helped their performance, right? The other thing is they're pretty smart about taking advantage of the government, right? F-35, which is made in Fort Worth, Texas, is made in an Air Force base owned by a government. It's made in buildings owned by the government. It uses specialized tools, which are owned by the government. So basically, the biggest program in the history of the defense and aerospace industry requires very little investment because they're doing it all with the government's money and materials. They got to hire the people, but basically the government wants it this way because they don't want other people kind of seeing how they're making these planes. But regardless, they've taken advantage of this to get advantages financially. They also get prepaid. They convince the government to give them like 20% at signing a contract before they even start the work, okay? And they're just really good at that financially, and they've been doing that for decades. So the point is, they do have some advantages which allow them to do even better than the rest of the industry. They have some very big programs which are giving them an economy of scale. And they are kind of locked in with their backlog, as somebody mentioned, for very long periods of time. Now, if you read the book, and we talked about this briefly last week, ROICs like this don't last. They should be regressing to the mean over time. So if you're thinking about 5 years from now, your initial bias should be lower spreads in 5 years. You don't see companies like this maintain it that often. Now, working with Lockheed Martin, I actually think they might be an exception. So if I were answering the C competitive advantage in 5 years, I think they're going to maintain it. But if you said it was going to go down, that would be reasonable, okay? The hardest one to say is it's going to go up even further just because it's so much of an outlier today than the industry. But you could say that, but you got to have a good real world reason to do it. The reason why I don't think it's going to change that much over the next 5 years is the nature of the long-term contracts. Like, they have some very profitable business locked up for a very long period of time. And I think that's going to outlast the next 5 years. Like, that's back to the F-35. They're the only ones that make the F-35. It's the only fifth generation fighter the U.S. makes. There is no alternative, right? And that contract's locked in for the next decade, okay? Same thing, they're big in hypersonics. So when they do hypersonics, they're one of the two companies that the U.S. government is betting on for hypersonic missile competition. They're big in cybersecurity. So as the world becomes a more dangerous place, like Lockheed Martin is one of the key companies that has helped protecting it. And I think that will actually benefit not only the industry, but asymmetrically benefit them. So for example, last week or 2 weeks ago, the Houthis, if that's how you pronounce them, actually did something, a world first. They used an intercontinental ballistic missile to attack a ship in the Red Sea. First time it's ever been done. Okay, never been done before, never been proven it could be done. They did it, hit the ship. Okay, that's actually one of the reasons why we're going to war with them and bombing the hell out of them, because basically they're attacking the shipping lanes. So it's not just the Palestinian-Israeli crisis over there. You got another crisis where they're attacking commercial shipping. Those are oil tankers and other ships that are bringing stuff around the world. We, the global cop, are out there doing the policing, and we're basically fighting them. But here's the point. The radar system that tracks intercontinental ballistic missiles is made by Lockheed Martin. It's called Aegis, okay? And it's very important anti-missile radar. So without that radar system, you can't shoot down a missile. They make it. Raytheon, RTX, makes the missiles that are being fired to kill it. The two companies together are what are now protecting all the ships. And by the way, as I was in a very morbid way explaining to the people, they are protecting you, okay? Because if one of those rogue nuclear missiles is launched at the US, one of the areas they're gonna wanna blow up first is right here, okay? Not only do they wanna kill all the people in DC, so we are not considered a human target, we are a military target. The other one is right up the road is the NSA. And the NSA is 10 miles north of here. They're also going to be one of the first missile targets that anybody tries to hit. So if a nuclear war breaks out, we're all going to die, okay? We'll be one of the first people incinerated 8 minutes after launch. So just YOLO, okay? Remember YOLO. But small probability, so you don't have to worry about that. But the one thing that will prevent you from incineration is sitting around DC are all the Aegis radars. and all the Raytheon missiles, missile defense. So if it's like one rogue missile, we'll probably kill it. If Russia launches 100, game over, all right? But that's the point. Look at what's happened in Ukraine. Like last year, the Russians were sending like 30 missiles a day, destroying all the infrastructure to bomb Ukraine in the Stone Age and putting everybody in the dark. Then the Patriots showed up with the Aegis missile systems, and now they fire 30 missiles. They hope to get through because we're shooting down 95% of every missile that's launched. That's our technology. That's this company's technology. This is being very popular in the world today because every other country in the world is looking at what's going on in the Ukraine war, and they're like, basically, Russia's a paper tiger. Everybody thought they had the second strongest military in the world, and the military turned out to be a complete joke. Their equipment doesn't work, their training is horrible, the Ukrainians are winning, and they're winning with our stuff. And they're killing the Russian stuff every day. Well, every other country that buys this stuff is basically saying, we want that stuff. And so Lockheed Martin is asymmetrically benefiting that because a lot of their stuff is the reason why Ukraine's been able to hold on for as long as it does. Now, the bad news for Ukraine is all the ammo is gone. And the US Congress won't approve any more ammo for the weapons to fire against the Russians. That's the fight we're having this week. But that being said, if we actually give them the ammo, they'll beat the Russians because the Russian stuff sucks. It's a joke. And everybody's watching this, including the Chinese, by the way, who are thinking about invading Taiwan. But that's a separate story. This is not a poli-sci class. But competitive advantage, those security threats benefit Lockheed Martin asymmetrically right now. And I think it will over the next 5 years. All right, questions about EIC? Everybody get somewhere in this analysis? Notice what I'm giving, it's not just opinions, I'm trying to relay it to things that actually give explanations as to why. Right? We're gonna have reasons why the data is different. Can't just regurgitate the data in this class. And you don't have to agree with me. You could disagree with some of the comments I make because we're talking about the future, and that's okay. But you gotta then translate that into what you're saying about those business changes, about any of the companies. Does that make sense? On Wednesday, you'll have another EIC assignment. You'll notice right now it's blank because I don't know who it's going to be. I'll rip a company out of the headlines in the next couple days that's making headlines, and that'll be our next assignment. So it'll be launched on Wednesday, due Monday. In the interim, today we're going to finish up lecture note 1. So I need you to go back to lecture note 1. And I want to talk about key value drivers. All right, this slide we briefly talked about in lecture note 1 last week or so. And I said this summarized the math for the semester. Today we're going to start the math. So I want to define a few terms that are very important for our semester. Okay, so one is a term called NOPAT or NOPLAT. Okay, NOPAT is the generic term, NOPLAT is the McKinsey term. Okay, same thing. NOPAT stands for net operating profit after tax. NOPAT, net operating profit less adjusted taxes. The whole idea is you want to take your operating profit or EBIT after tax as if you were a debt-free company. So basically, how much cash flow is a company generating from operations, right? And private companies or public companies that are public, that are not for profit, still have to pay taxes. All right, so that's why as an investor, we do this after tax, net operating profit after tax. It's basically your EBIT times 1 minus the tax rate. Now, when you make a profit, and in this example, this hypothetical company makes $100 million of NOPAT per year, there's 2 things you can do with that profit. You can either pay it out, that's called the payout rate, or you can reinvest it. Those are the only 2 things you can do with your profit. Now, we will overcomplicate this, because we'll say there's different ways to reinvest. We could build a plant, property, plant, equipment, CapEx. We could buy inventory. We could hire people. It's all just reinvestment. There are different ways to pay out. We could buy back stock. We could pay a dividend. We could pay off the debt. They're all just payout. So we get complicated about what we're paying out, but there's still payout. We get complicated about what we're reinvesting, but still reinvestment. So at a high level, those are the only 2 things you can do with a company's profits. You either put it back in or you pay it out. The amount you put it back in is called the reinvestment rate. Reinvestment is a percentage of profits. The amount you pay out is called the payout rate. Those 2 ratios have to add up to 100% of your profits. Therefore, 1 minus the investment rate is the payout rate. 1 minus the payout rate is the reinvestment rate. Okay? So in this case, 50-50. 100 million of profit, 50 reinvested, 50 paid out. Just the hypothetical example. Term number 2, G, little g, also known as the sustainable growth rate. This represents the rate at which a company can grow sustainably with internal funds. To grow beyond this rate would require either external funding or inorganic growth, M&A. Okay? So the other term we're going to define in here is called free cash flow. But let's start out with G. Okay? So taking this hypothetical company, which is reinvesting 50 million of its 100 million of profit, 100 million NOPAT. Let's say it has a 10% ROI today, and it's going to have a 10% ROI in the future. So it just makes 10%. Keep it simple. If they reinvest 50 million at 10%, that new investment's going to make 5 million of new profits. And if my core business keeps making 10%, I'm going to make 100 million on my core next year. I'm going to get 5 million for my new investment. My profit will grow to 105 million next year. That's a 5% growth rate. That's what's down here. Okay, that's kind of mechanically how it would happen, right? But I'm going to show you the shortcut. The shortcut formula for G, sustainable growth rate, is right here. You take your reinvestment rate, 50%, and you multiply by the ROI on that investment, 10%. So if I reinvest 50% at a 10% ROI, I will grow my profits 5% a year. That's G. So G is ROI, incremental ROI, times reinvestment rate. That's that 5% growth. So I can do it shortcut, or I can do it mechanically. I'm going to get the same answer. Everybody follow so far? Okay. So the question then becomes, how do I grow faster? How do I get my G higher without external funding? So let's say I take over this business and I decide I want to grow at 10% a year, not 5% a year. What are my two choices? How do I get this number over here to 10% instead of 5% in the upper right? How do I get that number to 10%? Yeah.
Reinvest everything,
So what would the reinvestment rate need to be?
100%.
So basically at 100% reinvestment times a 10% return on investment, I'd get a 10% growth. Now, what's the trade-off? If I made my reinvestment rate 100%, what would happen to my payout rate?
0.
So all those dividends you got, sorry, I'm cutting those. No dividends, no stock buyback, putting it all in the firm. That's one way to do it, but for a publicly traded firm, that might be difficult. Because even though dividends are not guaranteed, most people treat them almost like interest payments. They don't like seeing the dividend cut. Okay? So that might be bad in the short run. So I don't want to cut the dividend, but I could. That's one way to do it. So let's say I'm afraid to cut the dividend. What's my second option for 10% growth? So I maintain the 50% payout. Yeah.
Somehow get ROI to 20%.
So if I got my ROI for everything to 20% at 50% reinvestment, that would get me to a 10% growth. So snap my fingers, everybody in my company, double your profit with no more money. That's easy, right? Probably not so realistic, but here's the real point. ROI is related to growth, and that people often fail to see that. If you have a higher ROI, it gives you more ability to grow. That's why very profitable tech companies have so much cash and don't need to borrow money. Okay? Ironically, low ROI is massive need to borrow. Because you don't have a high ROI, you don't have the ability to grow, which means in order to grow, you got to go borrow money. And think about this. The time to go borrow money is not when you have low ROI, right? Because then you're convincing the investors, hey, my business sucks, I need a lot of money. All right? So that's a hard message on investors. So you're either going to get really bad terms or they're not going to want to lend you money at all. As opposed to, hey, I'm making 50% a year, can I have some money? They're banging down your door to give you the money. Because the rule of banking is to lend money to people who don't need it. The second you need the money, the banks don't want to give it to you. Okay? So let's go back to this. I'll show you how this works in the real world. Let's look at a company called Google. They just reported earnings last week. Now, I don't like to do what I'm about to do, But let's assume that Google's ROI last year is their ROI next year. They maintain their ROI. And if we look at our spread template, Google last year reported an ROI of, give me a second to let it load. Almost 25%. All right, so let's just assume they maintain that in the future, 25%. Okay, so here's the point. What is Google's payout rate? Does anybody know? Dividends? How much of a dividend Google pays? It's called DPS in Bloomberg, dividends per share. You can see the forecast on EEO, and dividends per share for Google for the next few years, 0. Because they don't pay a dividend. And they don't buy back stock. So what's their payout rate? They don't have one, 0. So theoretically, what's their reinvestment rate? 100%. So they can reinvest 100% because they're not paying anything out. Everybody see that? What is their ability to grow sustainably? What's their G? What's the reinvestment rate? And what's their ROI? So they can grow 25% a year with internal funds. Okay? So here's the point. How fast is Google expected to grow? Percentages? Revenue? 11, 15, 12, 11, 12 to 15? Somewhere in that range a year? So if they're growing at 12 to 15% a year, and they could theoretically grow at 25, what happens to the rest of the money? Because they make enough money to double what they're reinvesting, to double their growth rate, but they're not growing that fast. So what happens to all the money that they're not paying out? Their excess cash balance just grows. So that's the point. The reason all these big tech companies have such high cash balances, which is why Mark Zuckerberg could announce $50 billion worth of dividends when the stock went up 20% on Friday, excited the investors, is because the same thing. Facebook has a phenomenal ROIC. In fact, was it on the last screen? Meta? Is Meta on here? I think Meta is on this version of the screen. But if I switch over to Meta, same analogy, but Meta's ROIC last year, which they just announced, was 22%. Okay. Meta historically did not do any share buyback or dividend purchase, so it was 0 payout until Friday, right? But here's the point. Meta's growth is 16, 12, 12, 7, and they can grow at 22. So that's the point. They can afford to pay out that dividend because they can grow with internal funds. They don't have to borrow any money to do it. Does everybody see that? So that's what I just want you to start to understand. You can start to see how G plays out. Questions about G? It's a critical number we're going to use this semester. All right. The other thing I want you to know about G is an assumption that's made whether we tell you or not. Okay? And here's what I mean by that. We assume that growth in revenue and growth in profits are the same. And what we don't say is because if it has the same margin going forward, they will be the same. So we will use growth in revenue and growth in, and not just here, but in this class, but in the real world. We use growth in sales as a proxy for growth in profits because we're assuming that the margins stay the same over time. If the margins don't stay the same, then growth in sales do not equal growth in profits. Matter of fact, if growth in sales and growth in profits stay the same because of margin, and we maintain the reinvestment rate, then the growth in free cash flow is the same as the growth in our profits and our growth in our sales. So we'll use growth as a proxy for all three. But behind that assumption is that the reinvestment rate doesn't change and the margin doesn't change. If the reinvestment rate changes, the margin changes, then they will grow at different rates. But for most big companies, we tend to assume they stay the same over time unless told differently. So therefore, Just an assumption you'll hear in the real world, like why are people using sales and cash to grow at the same rate? And that's why. Okay? But here's the point. G is actually growth in free cash flow. And the book is using growth in profit for that growth in free cash flow, but they're also keeping the reinvestment rate the same. Everybody with me on that? All right. Definition number 2. Free cash flow. You are not worth the sum of your future profits. Businesses are not worth the sum of the future profits because you have to take some of those profits and reinvest to sustain the business. Okay? Buy a car, any car, brand new off a lot. Keep it for 10 years. Don't do any maintenance on the car. The car is not going to last 10 years. Okay? If you don't maintain a car, it's going to fall apart. It's going to die. So if I want to keep the car long term, I got to do some maintenance. Right? So that's the point. Companies are the same way. Companies have to reinvest some of their profits or the business is going to start to crumble. All right? There's a reason why the machine over there, that computer, is still dead. Right? Because Maryland doesn't have enough IT resources to actually fix the stuff in the room. Great irony of universities. All right, we got $300,000 worth of software in this room, and we got 6-year-old computers which are breaking down all the time that cost $1,000 to fix, but there's no money for that. Okay, so that's the point. You don't put money in these computers, eventually they die. You can't use your expensive software. You got to eventually put some money in here. Okay, but that being said, companies have to do the same thing. You got to reinvest, or the business can start to crumble. So you can't pay out all the profits. If you want to grow, you got to use some of that profit to help you grow. So that's the point. Because you can't pay out the profits because you got to spend some of the money to reinvest and grow, what you can actually pay out is the profit after that reinvestment. Now, there's no accounting term for that. Profit after reinvestment, there's no accounting term. So the finance people created our own, and that's called free cash flow. Free cash flow is profit after reinvestment. That is the theoretical payout rate of the business, because that's the cash after reinvestment that can be paid out. That's why businesses are based on free cash flows, not profits. Okay? And so the concept's pretty straightforward. Okay? You're worth the sum of your future free cash flows. That's your payout rate, because that's the profit after reinvestment that's available to pay out. That's your discretionary cash. Right? Now, the trick is not the concept. It's the mechanics of figuring it out, because the accountants never set up accounting statements to calculate free cash flow. So we have to rearrange those statements to calculate free cash flow, and that is a pain. The good news for you is that's the second section of this class. You're going to learn how to painfully do something that is not standard and do it right. Okay? And the concept is pretty straightforward. It's gross cash flow, which is the cash coming from the income statement, minus gross investment, which is the cash reinvested in the balance sheet, and the difference between the two is called free cash flow. And that is the value of the firm over time. Okay? That's basically what we're going to be doing for the second half of this class. Right? So here's McKinsey's approach, just so you know. Because free cash flow is hard to calculate, and because ROIC is easy to calculate, and ROIC equals free cash flow over the long term, McKinsey's an ROIC-based valuation company. That's the book. And so it's just an easier thing to do because it's easier to estimate ROICs than free cash flows with our current systems. And ROIC equals free cash flow. And so that's the next point I want you to understand. ROIC equals free cash flow. So again, this is a very important slide to illustrate that point. So far today, I've been talking about a company, a made-up company that has $100 million in profit, growing at 5% a year, reinvesting 50% of its profit at a 10% ROI. That's the company on the left. I'm going to add a competitor, a peer, company B, made-up company. It also has $100 million in profit, growing at 5% a year. So these two companies have identical profits, starting with $100 million, identical growth rates, 5%, 100, 105, 110, ... Identical risks, 10% wax. With all that data, would these two companies trade at the same value? Would company A or B potentially be worth more? And if so, why? So given the data on this slide, is one of these two companies more valuable? A or B? Yeah.
B, because the free cash flows are higher?
Exactly. So because B generates more free cash flow at the same discount rate, they would be more valuable. Everybody see that? But the reason I want you to see this, is the why. So B generates these free cash flows, 75, 79, 83. A generates 50, 53, 55, ... When I forecast those, these cash flows are going to be a higher NPV. Okay? But here's why. Why does A need to reinvest less, or sorry, A need to reinvest more than B, who reinvests less to generate those profits? Yeah. Because B has a 20% ROIC and A has a 10% ROIC. So let's assume B's not cutting corners and B's really better at what they do. Because I'm better at what I do, I can make a 20% ROI, I don't have to invest as much to generate the same profits. And therefore, I will generate more free cash flow. Or, what if B invested 50, not 25? How much profit would they make if they invested 50 at a 20% return in year 2? If this was 50 at 20%, profits in year 2 would grow to 110. So if I reinvest the same at B that A does, I'll have higher profits. If I have the same profits that A does, I won't have to spend as much. In either case, a higher ROIC equals more free cash flow, and therefore more value. And that's a core concept. So ROIC is the proxy for free cash flow. It's just the shortcut. And if you generate higher ROIC, you will have more free cash flow. And you will, at the same risk, be more valuable. But here's the caveat. At the same level of growth. So as long as the growth rates are the same, higher ROIC equals more value. What gets tricky in the real world, which we will cover this semester, is the growth rates aren't the same. Okay? So the growth rate ROIC combination leads to value creation. Okay? So I want to show you this. So let's say, and I'll do this in Excel. So open up Excel. Blank workbook. Make it a little bit bigger. So let's say I start out with a 10% ROIC, 0.1, and the other company has a 0.2, 20% ROIC, 0.2. Okay? And the company with a 10% ROIC grows its ROIC at 2% a year. Okay? So here's how this would work. You start out with 0.1, you multiply by 1.02, and that would be their value in year 2. And then what I'm going to do is just carry that out over time. But the company with 0.1 doesn't grow at 2%, it grows at 15%. Sorry, 15% per year. So start with 10%, but grow at 15% a year. Company with 20% ROIC grows at 2% a year. So equals 20% times 1.02. What's going to become more valuable? The company that starts with 20 cents growing at 2% a year, or the company at 10 cents that grows it at 15% a year? Which one's going to lead to a bigger value? Well, if we copy this out, somewhere around here, 6 or 7 years out, the 10% growing at 15% a year is going to be more valuable. And as we play this out over time, it's going to start being a bigger gap. So that's the point. That's valuation. That's what we're going to be doing this semester with real world companies. There's 3 things that matter to a company's value. Tell me your ROIC, tell me your growth rate, and tell me your discount rate. You know these 3 numbers, you know stock prices. All right? Now we're going to get a little more granular as we click down, but that's the concept. Okay? That's operating cash flow value based on key value drivers. Questions about that? So, ROIC is a proxy for free cash flow at the same level of growth. Okay? Now, the difference between a project and a company is we assume companies last forever. Projects end, companies last forever, right? Now, I don't know if Google's going to last forever, right? But we assume when we value them that they're going to be here for a very long time. So if I'm going to value Google's cash flow for a long term, that's called a perpetuity. And if that cash flow grows over time, that's called a growing perpetuity. And the formula at the bottom of the page is called a growing perpetuity. Cash flow divided by R minus G. That is how we value companies long term. That's what we use for continuing value. That's what we use for multiples. That's what we use for stock prices. That's what you were taught in business school. That's what they use in the real world. Cash flow divided by R minus G. Right? There are two challenges with this equation in the real world. Number one, we're simplifying the entire business to three numbers to value the companies. Deal with it, it's what we do. Okay? Challenge number two, though, is a math problem. The fundamental math problem with the growing perpetuity equation that we're all taught, that we all use, is that the internal rate of return on incremental cash flows equals the incremental rate of return on historical cash flows. Translation, whatever ROI you make today, you make forever. So back to Google. If Google's making 25% today, and we value Google using this equation, they will make 25% into perpetuity. Now, we know that companies don't maintain their high returns forever. So we're likely going to overvalue Google because as their returns start to lower in the future, we're not forecasting that to ever happen. They will never regress to the mean. They will always have that highest spread, and we will tend to overvalue them as they mature. Same is true with undervaluing. If I value Ford right now because they're spending a bunch of money on electronic vehicles and they're making 3%, and basically over time they start making 7, 8, 9, 10%, right, as the vehicles are sold, my perpetuity will never give them credit for that. If they make 3% today, they make 3% into perpetuity, which means I will undervalue a cyclical company. And that's the problem with the math we use. You want to see it play out today? Tesla. Tesla had a really good run the last 3 years. That led to a stock price which is 40% higher than it is today. And the fact that Tesla's share price is coming down should not surprise anybody because they weren't going to grow at that rate forever, and they weren't going to have that ROIC forever. And the fact that we convinced ourselves that we would, shame on us. And now as Tesla's going back to a more realistic growth rate for the long term as they mature, and as the ROICs come down to a more realistic growth rate that the industry is earning, we are shocked to find that there's gambling in Casablanca, and we are shocked to find that Tesla's not worth what they used to be. It's the problem with the math, right? By the way, the private equity firms exploit this all the time, but that's a different side of the story. So here's the point. This is McKinsey's improvement to this problem, which is another key premise of the book. It's called the key value driver equation, which is one of the most important equations we're going to use the entire semester. It's going to rearrange the growing perpetuity. Here's how they do it. Growing perpetuity, cash flow divided by R minus G. Cash flow is free cash flow. Profit times 1 minus the reinvestment rate. Growth, G, is the investment rate times the ROIC. Therefore, investment rate is G over ROIC. The formula on the right is a growing perpetuity. It is just being rearranged from the formula on the left, which is the one we use every day. Okay? But here's the benefit of the McKinsey version. The original formula on the left does not have ROIC in it. I can't change the ROIC of the company today in the future. The formula on the right has ROIC explicitly stated, which is incremental ROIC. So I can have a different ROIC for the future than the present. That's the improvement. Now, it's still one ROIC for the entire future of the business, but at least I can pick something that is more representative. So I'm valuing Google, I'm making up numbers, 25% right now ROIC, I think it's going to average 15% in the future. I can get a better valuation using this formula because I can put 15% in here for their future. I can't do that with the original perpetuity, and I'm stuck with 25% forever. That's why the McKinsey version is better. Not perfect, but it's better. So there's two premises in the book. ROIC is a proxy for free cash flow. The key value driver formula allows you to demonstrate an ROIC that's different than today. Better or worse, but more representative. That's why their stuff is better. Questions? Final point for today. That's the key value driver equation, KVD. Okay, you'll be using it a lot this semester to value companies long term. So that's the equation. This is the example. I intuitively asked you, who's more valuable, A or B? And you said B. We talked about why, because they have more free cash flow. What I want to do is, using that equation, quantify it. So use the key value driver equation, quantify it. So in ELMS, in the files folder, last week, I put up a folder called KVD. So in our class folder, there's a folder called KVD. Courses, spring. There's two files in here that matter. One is a spreadsheet that doesn't have 0 bytes on it. I don't know why the other's there. And the other is a PDF file. Okay? So I'm going to start with this spreadsheet. So in the spreadsheet, just a preview of it, what I've done, actually let me download it, so it'll just be easier to see it the way you should be looking at it. So here is the spreadsheet. Is I've taken from the key value driver formula this formula, using those data points, estimated a value of each company. So profit, 100 million for each company. Growth rate, 5% a year for each company. That's my G's. ROIC of company A was 10%. ROIC of company B was 20%. WACC, 10 and 10. Plug those values in to that formula. That's the formula. Okay. Company A is worth $1 billion. Company B is worth $1.5 billion. So quantitatively, company B is worth 50% more than company A given those data points. What's different about B than A? What's different? The only thing is the ROIC, right? And I told you if you had a higher ROIC, you'd have more value. There's the point. They got a 20% ROIC, everything else is the same. They're worth 50% more. There's something called a PE multiple, price to earnings multiple. Company A will trade at a PE of 10. Company A's value is $1 billion. Company A's earnings is 100 million. Billion divided by 100 million, PE of 10. Company B, value of $1.5 billion. Earnings 100 million, PE of 15. ROIC is the shortcut for free cash flow. Multiples are the shortcut for free cash flow valuation. They have to be related. It's mathematically rearranged equations. And this is section 4 of the class. Has to play out in the real world. All right? So here's where we're going to go with this. We're not going to have enough time to do this today. But in class on Wednesday, you can start it playing ahead if you want. The other file in this folder is a simulation that starts from this point called key value driver simulation. Ignore Duke, I teach there, it's my stuff. But basically, we're going to go through this key value driver simulation. And what I'm going to ask you to do is go through these 6 scenarios. You're going to start with that spreadsheet, and you're going to plug in these scenarios and see what happens. And I'm telling you, if you understand these 6 scenarios, you'll understand what's going to happen with any company and how their information changes and how it'll lead to change in valuation. So whether you're reading in the press and you're trying to figure out, like, how will this impact a company, it'll be one of these 6 scenarios, right? And then every decision we make will usually follow one of these 6 scenarios and how it will play out mathematically. So yes, we're going to get in the granular detail of all this stuff, but if you're trying to understand the big picture, like what could happen for value creation, these are the 6 scenarios. So basically, starting with this, we're going to play through these 6 scenarios, and then we're going to take these scenarios and we're going to put them into the real world. Okay? That's where we're going next. So we don't have time to go through the simulation today. We're going to do this in class on Wednesday, but if you want to get a look ahead, feel free. And after that, I'll then give you a second EIC assignment, which will be homework 3, which will be due on Monday. Okay? Where's the sign-in sheet? If you haven't signed the sign-in sheet, please sign it before you leave today. Otherwise, have a good day. See everybody on Wednesday.